Welcome to No Stupid Questions with Susan Edmunds, the podcast that helps you get answers to all your money questions. If you have questions you want answered, you can email them or voice memo them to questions@rnz.co.nz. We try to answer as many as we can. If we don't get to yours, it could be because it's getting too specifically into personalised financial or legal advice, or it could just be that we have had a lot of great questions and we haven't got to it yet. Thanks for all your support, and please do keep your questions coming. I'm joined today by Justin Gregory.
I join you every time, Susan. Why make it sound so novel?
I know, I'm sorry. You'll be pleased to know that I haven't had an entire half litre of Red Bull today, so I might go a bit more slowly.
Excellent.
We've got lots of questions about interest rates this week, which I guess is topical given the big cut to the official cash rate we've just seen.
Yep, and our first question is from Shane. He says, every now and again the government talks about the banks passing on savings to the customers, but nothing really seems to come of it. The big Aussie banks have to deal with a higher cash rate from the RBA and are subject to the same global wholesale rates as we are, yet they charge the Aussie homeowners lower interest rates than they charge us here in Kiwiland. Susan, is this right?
Well, this is a really good question, and it's one I have tried to look at in the past. First, I agree that we haven't had the full impact of the recent OCR decision passed on. Floating rates so far have dropped by about 40 basis points compared to a 50 basis point cut. It's harder to gauge with the fixed rates, though, because they can move ahead of the official OCR decision as wholesale markets move, because they sort of anticipate what's going to happen as well as what has happened. ASB put out a report this week that showed that compared to an OCR cut from 5.5% to 2.5%, or 3 percentage points, floating rates have dropped 2.7 percentage points, 6-month rates dropped 2.5, 1-year rates 3, 2-year rates 2.4, 3-year rates 1.9, and 5-year rates 1.6. So by that measure, you did the best out of the 1-year rate so far. I guess one thing I should note is that sometimes banks can be balancing depositors' needs too. So if they have to offer higher rates to keep deposits coming in, it could affect how much they can cut lending rates. And as for the Trans-Tasman comparison, Australian banks have a net interest margin, that's the difference between what they charge borrowers and what they pay depositors or savers, of less than 2% according to the Reserve Bank of Australia. The Reserve Bank of New Zealand, though, says that our big four have net interest margins ranging from 2.2% at Kiwibank to 2.5% at ANZ, so they are making more money out of lending on this side of the ditch. And Aussies also tend to like floating their home loan rates, while we're all about fixing, which creates a different dynamic too. Canstar said last month that Australian floating rates were a minimum of 5.14% and an average of 6.18%. And at that time, ours were 5.7% at a minimum and an average 6.3%. But our 1- and 2-year rates, which we were more likely to choose, are a bit lower. But that's not always the case, and we see them move around quite a lot. Sometimes the Australians are getting a better deal. I talked to Claire Matthews from Massey University, who is an expert in this stuff, and she says there's a few things going on, and although rates here do look better than Australia at the moment, that net interest margin is going to keep them up.
At the moment, it doesn't look like they are too different. In fact, the ANZ ones look a little higher, which you would expect them to, given that their equivalent of the OCR is a little higher. What it reflects is costs. So there's the cost of money, but there's the additional other costs that they might be incurring and their expected profit margin. We'll call it a profit margin, but it's the net interest margin. So it's part of the fact, it all goes back to the fact that, there's all this comment about the banks in New Zealand make a higher proportional profit than the banks in Australia. And so part of that does come back to the fact that they are charging slightly higher interest rates in New Zealand, and that reflects the fact that they want a higher return. So they're looking for a higher return on what the business that they're doing in New Zealand, and so to a large extent that's going to be reflected in slightly higher interest rates. Banks will compete where the most interest is. And so because New Zealanders are focused on the fixed rates, that's where the banks will mostly compete, and because that's where they're doing their most business. And so Australia will focus a little bit more on their floating rate because that's where they're doing most of their business, and that's where they need to be competitive to get the business.
Yeah, that makes sense. Okay. So if the OCRs were the same, then we might have higher rates, but
yeah, if the OCRs were the same, then yes, I would generally expect New Zealand rates to be slightly higher.
She also says the point about wholesale rates might not be as straightforward as you might think.
They might be borrowing at slightly different rates because the New Zealand banks are slightly smaller than the Australian banks, so they may not be getting exactly the same wholesale rates. But then again, the margin that they're going to apply to those is going to be slightly more in New Zealand than Australia.
And this actually reminds me of a conversation that I had with a colleague last week. He fixed his mortgage for quite a long time when he bought his first house, and he now has fixed regret because he's still got about 18 months left to run and is seeing rates fall all over the place in the meantime.
Yeah, I can relate. I fixed my rates just a few months ago and I'm already regretting it. But anyway, sounds like this is a pretty common feeling.
Yes, it probably isn't as common at the moment as it sometimes is because a lot of people have been fixing for quite short terms lately. Reserve Bank data shows that the bulk of fixed home loans are due to refix within the next year or less.
Mine aren't. They're not short term. That's all right. So if you're like me and you do have fixed regret, what can you actually do?
You can look at breaking your fixed term if your regret is really bad. You'll usually be charged a break fee though, and that's calculated in a way that can mean it doesn't make sense to do it. Basically, the bank will look at how long you have left on your fixed term and what interest rate it could lend that money to someone else at, and then it asks you to cover the difference. So if you're coming off a high interest rate, you could end up with a really big break fee. I've seen that go into tens of thousands of dollars in some cases, though I'm not sure that anyone actually paid that. But it's something to talk about with your bank to see what might work. In some cases, you can get a cashback incentive from another bank that might help cover the cost. They pay those when they're trying to pinch business from each other, basically. But if you only took your loan out recently, as our colleague did, that's probably not an option.
Me.
Yeah, and you, because if you took a cashback from your bank at that time, you probably agreed to stay put for a period of years. And actually, his rate wasn't too bad, so I think he will have the opportunity for much more fixed rate regret in future.
Now, the next question is from an anonymous listener. They didn't want to leave their name. Okay. What is the main driver behind the cost of living crisis? More precisely, could you explore how wealth gaps might be shaping the broader economic pressures we're feeling?
There are lots of aspects to this question, so I'll try to break it down to really basic terms. The cost of living crisis of the past few years was mostly driven by inflation running at a higher pace than our wages were increasing. In terms of wealth gaps, I think one of the most obvious inequality issues that we've seen through this period has been that a lot of the biggest price rises have been in things that you can't really avoid spending money on, particularly food, but also things like insurance and rates, things that make up a greater proportion of a lower income household budget went up most. That's mostly the food bit. That's also why, for lots of people, although the headline inflation numbers have come right down now, well, not right down, but they've fallen quite a bit, it still hasn't felt much better for a lot of people yet. I think we'll need a really sustained period where the price of essentials is pretty flat while incomes catch up for that to improve. Higher income households were really affected by higher interest rates because they tend to have more debt, but they have had some relief there, as we know, although maybe not as much as you'd like if you fix too soon. And they've still got the prospect of it coming through as well. But that just hasn't happened for other things like the power bill or the supermarket shopping.
And we've got another one here about interest rates. It's from Colin. Why don't OCR cuts affect credit card interest rates? Good question.
It is a good question. I've looked at this a few times in the past, and I think there are a few reasons. One is that most people don't think they're ever going to have to pay interest on their credit card because everyone likes to say, oh, I pay my balance in full every month. So there's less competitive pressure on credit card interest rates, and they can stay higher. Another is their unsecured credit card debt. So the banks don't take any security, in theory, against that loan. And banks often say they're taking on more risk and they want a higher return because of it. I have noticed that the credit card market's becoming a bit more competitive though, just in recent years. You can get lower interest credit cards that don't have any fees, but they don't have the bells and whistles of the rewards schemes, but they can be a good option if you just want to go for cheap and cheerful.
And since we talked last, Susan, you've had a couple of stories that have generated a lot of interest online, and they're all related to the IRD, the Inland Revenue Department.
I know. Yes, I always think people think, oh, tax is very boring, IRD is very boring. But anytime I write something about either of those things, people are quite interested. So it's an interesting phenomenon. But basically, they both tied into IRD taking more action against taxpayers who owe money. Estimates are that there's now about $10 billion in tax debt outstanding, and the department has more funding and new systems that make it easier for it to chase it. So it's doing that in a few ways. It's calling people who owe money to tell them, and it's taking money directly out of people's bank accounts, which isn't very popular with the people that it's taking the money from. In my story, I noted that it had sent out 16,500 notices about planned bank deductions since mid-June, and that's 25% more than in the whole of last year. So we had some feedback from people who said money had been taken from their accounts. They said they didn't get much warning. But I should note that IRD says there are final warnings and communication sent before it happens, so it shouldn't be a surprise. But I guess it's never a pleasant situation to be in. And the other thing IRD is up to is making it easier to report businesses with debt owing to credit agencies. So that's designed to stop a situation where a business could be racking up a lot of debt and other creditors wouldn't realise until the company went bust. And then the IRD is top of the list and gets its debt repaid, but potentially no one else does. But I think the message from all of that is that if you owe tax debt, whether you're a personal person or a business person, you need to try to get in touch with IRD and work out something, because it's not messing around anymore. It's coming for you in your unpaid tax.
It's time for our question for you. Last week we asked when you thought we would see King Charles's face on our banknotes and coins. What's the answer, Susan?
We'll get a 10-cent coin featuring King Charles coming into circulation in 2027, and the rest of the coins will follow in 2029. Apparently, Buckingham Palace has made it clear that we shouldn't be wasteful, so we're rolling the currency into the system as it's needed, rather than replacing it just because we can.
He's famously thrifty, King Charles.
Down to the 10 cents.
Down to the 10-cent coin. Now, our next question for you is also speaking of cash. Which country was the first to introduce paper money?
As always, we'll tell you next week, but in the meantime, send your answers as well as any other questions that you might have to questions@rnz.co.nz. Thanks so much for all your emails, messages and voice memos. Bye for now.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. Justin Gregory is the producer. The engineer is Phil Benge. Thanks to Sam and Colin for the questions, and Claire Matthews, that's me, for her answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.